anything's possible. Keep in mind, it's a global bust. I think there are places that are in worse shape than we are. I think Europe's going to get hit very hard. I think China's going to get hit very hard. Japan's going to get hit very hard. Canada's going to get hit very hard. There are just excesses and imbalances throughout the globe that have not been dealt with for cycle to cycle to cycle for so long. Part of my thesis is that we are in the final decade of a super cycle. I define a super cycle as that long cycle between two depressions. 1930s was the last depression. I think the 2030s is the next one. So even though I'm calling for this dire forecast next year, it's not a depression. And I differ from the Austrian school that thinks we're at that reset now, that this is the end of the super cycle or the end of whatever they want to call it, and that we're going down for the count. My argument is that as long as you have the printing press, you can kick the can down the road. I think the time when you run out of the printing press is going to be the mid-2030s, because by then, because of the response to this bust, you're going to have a hyperinflationary cycle that could take inflation to 25% in the U.S. And, by the early to mid 2030s. And so at that point, long before we get to 25%, probably by the time we get to, 12 or 15% or before, the Fed's going to be out of the game. The printing press will have been shut down for the balance of that cycle. Once you lose the printing press, you have no answer for an unwinding system. And so I think, unlike the Austrians who think we're at the end of that period now, I think we have one more kick the can down the road cycle. It'll be a shorter cycle, it'll be an inflation cycle, it'll be a commodity cycle, or driven by commodities and inflation. You can't print $20 trillion and proportionally similar around the world and not have a recovery. You're going to have a big recovery, but it's going to come with a very rapid run-up in inflation. Think of what our Treasury is going to have to do. If they can't service debt at 5%, how are they going to service debt? Because rates will track inflation. We'll be back to that 15% long bond. I was in the business back in the early 80s running money. We had 15% long bond, 15% 10-year. I think this time around, we're probably going to see it somewhere closer to 20, certainly up in the high teens. There's no way you solve that equation, and T-bills will be over 20. There's no way when, our debt is not going to be 37, our government debt, it's going to be higher than that by a lot, and we're going to have to service it at high double-digit rates. There is no equation in the world that can solve that. And so that's why I think we'll see a collapse in, mid-2030s. Basically, again, this is the end of the super cycle. You start out slow coming out of depression, and each successive cycle, you have more excesses, more imbalances. It requires more response, which leads to an even more excessive next cycle. And that's just ratcheted up through, 90 years. And ultimately, you come to that point of no return where, you have no answers. 2008-9, we saw things that we never thought we'd see, right? I mean, it was scary. It was the biggest financial crisis in history, really, and particularly the magnitude of it. Because of the greater leverage this time, and because of what's happened this cycle, I mean, look where the S&P's gone from, where it was bottom in 2009. I think the S&P was 666, wasn't it? I think it was down there. And we've gone from there to what looks like 8,000's the number, and I think I may be conservative at 8,000. So it's had a huge run. Obviously, the tech had an even bigger run, and everything is levered up. We have derivatives playing a big role in everything. We not only have, the options we've had for a while, we now have daily options that get played. It's a casino out there. And again, that leverage helps fuel things on the upside, but once it rolls over, there's going to be things coming down so fast because of leverage. It sounds crazy to talk an 80% decline. Like I said, we haven't seen anything like that in the post-World War II period, but I think that's where we're at. And doesn't mean it'll be 80%. Do I know it'll be 80 instead of 70 or, something like that? No, but I think that's in the ballpark of where we're going to go. And think about fixed income. When I was back in earlier time in my career, I was, heading up active equities at ITT Hartford, and their life company was loaded with bond derivatives. I mean, that was how they managed. They were doing very well. They didn't have a big real estate portfolio, so it saved them back at that time. This was back in the late 80s, early 90s. 90s when so many got hit in the real estate bubble. But I learned the language of IOs and POs and residuals. And even though I wasn't managing the fixed side, it was really an amazing thing to see what Wall Street had created. You could take a treasury bond and cut it up into these other pieces. And, one money manager might want the interest only for their objectives. Another one might want the principal only for the appreciation. And then somebody else might gamble on the residual that if certain assumptions worked out, they made a lot of money. If assumptions didn't work out, they lost a lot of money or they didn't make any money. It was just amazing to see, what Wall Street was capable of. And, that was 30 plus years ago, and we've done so much more financial witchcraft since then. And it all adds to greater risks when things come tumbling down. Yeah, I'm a huge gold bull, have been, through thick and thin. Had to deal with several years ago people being disappointed with gold, but I've stayed pretty much bullish through all of that. Gold and silver both. Silver has been a tougher hold through that, but I have a 4,000 target on gold. My silver target is 75. I think you are going to pretty much right now begin to finally see that gold-silver ratio start to favor silver, start to roll over. This last leg up surprised me a little bit, but I still think you're ultimately going to see silver far outperform gold going forward through the balance of this year. But that doesn't mean gold's not going to perform, because gold's going to perform very well as well. We could be in an economic recession well before 26, but I think it will ultimately morph into a bust, whether that happens, in the fourth quarter, sometime late in the fourth quarter, or whether it gets pushed into 26, I don't know. Bust is something that comes on fast and you can't really predict that precisely, but I do think most of 26 or all of 26 is pretty much a very rough period. Stock market could bottom sometime in the latter half of 26 and start looking over the trough, so you could see that 1600 type level sometime in third or fourth quarter next year. It's not going to go straight from peak to trough. You're going to have probably a couple bear market rallies of substance. So you could go down 40 or 50% in the first step down and then rally halfway back over a couple months because the Fed eased or what have you. It looked like they were doing something, but it wasn't enough. And then another leg down to lower lows and maybe even a third leg, another rally and a third leg down. So that could play out over, I say 8 to 10 months. It might even take as much as a year once we top out. And I would say, just importantly to note, not only do I have a target of 8,000 for the S&P, I've got a 55,000 target on the Dow, a 27,000 target on the NASDAQ, and the one that's kind of controversial is a 3,300 target on the Russell. I think the Russell has been held back partly because of the Fed's restrictiveness, and I think you will see as the Fed comes in, whether that's June or later, that will really get the Russell going. But the Russell is starting to show a little more life, and I think we'll do that going forward. I'll talk about some other commodities because I think natural gas, which is has been on the floor through this whole cycle because of the mass amounts that they've found and the supply. I would not be surprised to see natural gas at $50. I would not be surprised to see copper, which I used the futures number. I'm calling for $6 pre-bust. So this year, I would not be surprised to see that down to $1 or $2 in the bust and then up to $20 or $25 in the next move. So just looking at those kind of things and what I said about oil. Obviously, gasoline will go through the roof. I think people do not understand is that real estate is not an inflation hedge. So whereas a lot of commodities are going to go through the roof and there will be inflation hedges, I think gold's going to 20,000. I think silver's going to 500 when oil goes to 500. But home prices, I think, could drop as much as 30 to 40% in the bust. And I don't think they're going to be inflation hedges in the next cycle. Why? Because mortgage rates are going to be high double digit. How in the heck are we going to see people afford a mortgage payment if they've got a 15% mortgage? So the inverse of a rising mortgage rate is a falling home price, right? So there'll be periods coming out of the bust with all that money created. You'll have some bounces in real estate, but I believe real estate, probably more so in Canada than here even, because you guys have had such a big run. But I believe real estate is peaking. At least in this country, it's already peaked. We could have a bounce as rates come down this summer, but I don't think you're going to get past the peak. And I think the peak of this cycle probably stands for decades to come. So real estate is not an inflation hedge. I believe the 10-year can fall to as low as 2.5%, 3% during this final melt up. So during the next 3 to 6 months. while everybody else is worrying about 5%, I'm saying no, it's going the other way. And I believe it will keep going. It may back up a little bit somewhere in there, but I think ultimately in the bust, you're going to see a 0% 10-year and negative short rates. I'm telling you, there are some great opportunities if you manage your money right. And I can promise you, if you go along with the consensus, you're not going to have that advantage. But if people understand what's coming and play their cards right, we are finishing a 43-year secular bull market, which means higher highs each cycle. That's coming to an end, and we'll have lower highs going forward. And ultimately, if I'm right about a collapse of the global financial system in the mid-2030s, these things are going to the floor. So people hear that and they get nervous, and I go, you're going to have such a tremendous opportunity in a different leadership coming out of the bust. If oil goes from 30 to 500, there's going to be plenty of producers that are going to make you plenty of money. What you won't make money in, or won't certainly outperform in, is an S&P index fund. If rates are going up from 0 to something close to 20% in the next cycle, PE multiples are going back to single digits. And so there'll be opportunities in tech. We're entering a world of AI and stuff. There'll be some big winners in tech, but generally it will not be growth stocks in the next cycle. This cycle was growth stock. Next cycle will be commodities stocks and commodities. So it's going to be important to understand the change is coming, because it's going to be a whole different financial world out there going forward.